Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
Happy New Year from ETF Market Insights. Welcome back. I hope you all enjoyed your holidays. This is our first show of 2022, and we're so happy to have you back with us. And some brand new slides as well. These look pretty good. Thanks to our team at Prosper for putting these together. Just going to start with our disclaimer slide as usual. So just as a reminder, we're not providing any advice today. We're not providing any recommendations. We're here to just talk about the markets, talk about ETFs. It's all really about education. I will also like to remind anyone who is joining us from YouTube and watching a replay of this event, any data we reference today, any performance numbers or distribution yields, that is all as of this week when we put our show together. So just keep that in mind. Those numbers are subject to change. So you have myself and Chris Heeks today. Chris, of course, is a portfolio manager at BMO, taking care of all those ETFs and monitoring those portfolios. So thanks to Chris for joining us today. We are going to talk about US dollar ETFs. We call those .U ETFs because the .U extension on the ticker, that's how you find them. And they are listed in Canada. So we can get into that shortly, all the benefits of .U ETFs. But we always start out with a tool to give you guys to look for that you can use or access. So if you visit our etfmarketinsights.com website, we have a fantastic education center. And within that, we have investor resources. And I'm going to direct you to our largest and most liquid reference guide. We update this quarterly. And really what this shows you is all the ETFs in Canada, not just BMO ETFs, that are the largest by assets and the most liquid by trading volumes, just to give you an idea of what ETFs out there are the largest and the most liquid, if that is data that you are looking for. We also have our BMO ETF roadmap. This is a great tool to sort out all the BMO ETFs and to see every single ticker in kind of a one place, really organized view sorted by equities and fixed income. If you're looking for a specific ETF, that is a great resource as well. So we're here today, we're going to talk about currency options that are offered with ETFs. Specifically, we're going to talk about those US dollar currency options, but we're going to start with a little history lesson about ETFs in Canada and these currency options that are available to investors. Chris, what can you tell us about currency options in ETFs, and how is this such an added benefit for investors using these ETFs?
For sure. Thanks, Danielle. Good to be here. Happy New Year, and glad to be back on our seminars here. Currency is one of those things that's kind of sometimes it's a secondary concern for investors, but you can see, and we'll see as we go through it, they can really be a strong component of returns. And Canadians have historically often hedged their currency exposures. So looking at our history of currency, different currency exposures within ETFs. The first currency hedged ETF was launched in 2001. It was actually launched by members of our own BMO ETF portfolio management team, although at the time working for Barclays Global Investors. Actually, back then, if you remember, there was foreign investment restrictions, so you couldn't even buy too many stocks in a fund outside of Canada. So this is quite a different event, but this ETF used a futures-based strategy, and then it hedged the currency exposure with currency forwards. So, anytime you're investing in foreign countries, if say you're investing in a US equity, you're going to have two sources of return. You're going to have the equity return in the local market and then the currency return. So something Canadians have always gravitated to is currency hedge products. So as you can see there, first was in 2001. BMO ETFs launched its first currency hedge product. The ZUE in 2009, one of the original BMO ETFs, launched 12 years ago now, or 13 years ago, I suppose. And then we move forward, there's other options as well, and ZSP, which is the largest ETF in Canada, and the largest ETF obviously at BMO, which is simply the BMO S&P 500 Index ETF, which is offered both in the regular Canadian dollar version as well as the .U, the US dollar traded version. That was launched in November of 2012. And if you go back then, the Canadian dollar was trading at parity, so a little different than now, and there was quite a demand to have unhedged currency exposures. And increasingly, as I think we're going to talk about it as we move forward in the talk, the demand from investors for US dollar traded ETFs that trade here in Toronto, and there's going to be a few advantages and how those can really benefit investors. But yeah, certainly it shows you, the development of the space, and there's been a lot of innovation to bring some of these different currency options to end investors.
Yeah, I found it really interesting just looking at this, that the hedge to CAD tickers were the first to be listed, and then we evolved to the unhedged version and then the .U versions a few years later. Chris, can you just give us a high level kind of 101 on what is currency hedging and then the difference between a hedge and an unhedged on an ETF?
For sure. So, it starts with for investing in, foreign equities, such as say the S&P 500 or the MSCI EFI, which is, Europe and Asia and Far East ETF. Anytime you invest in a non-domestic exposure, whether equity or fixed income, you do have direct currency exposure as well. So I mentioned you buy a US stock, you're going to have exposure to the returns of that stock, but also returns of the currency between US dollars and Canadian dollars. So there's two components of return. What currency hedging is all about is really minimizing the impact of that currency return. So when you are investing in a currency hedged product, those returns will tend to be very similar to the returns that those assets have in their local markets. So let's say if Microsoft is up 30% in a year, in the local market in US dollars, say if you're a Canadian but you're hedging that to CAD, you'll probably have about a 30% return stream, but in CAD as opposed to USD. So those are the two main options. Hedged is where you kind of mitigate the impact of foreign currency movements, and unhedged is where you are exposed to both the asset returns as well as the currency returns.
Great, thanks for that, Chris. So ETFs provide currency options, and investors in Canada, they have basically three main currency options to choose from when they're looking at equities or fixed income that's outside of Canada or non-domestic. So they can choose that local currency exposure, which is the unhedged version. You can go to a hedge to the Canadian dollar version. But today we're really going to talk about a US dollar denominated version, which is a .U. And this is not a hedged or an unhedged product. This is actually a product that trades in US dollars. So you purchase it in US dollars, it trades in US dollars, you receive your cash flows in US dollars, and when you sell it, you get US dollars back. So a little different than the hedging process. And what's great about these currency options, not only can investors tailor their portfolio exactly to the currency exposure that they prefer, but they're not paying an added fee for it. So if you look at ZSP as an example, so BMO's S&P 500 ETF, across the board, all three currency options, you're charged the same management fee. And I think this is a really great benefit, especially when you think about, Chris, I know you work on the hedges and rolling those over every month and the work involved in managing that kind of portfolio, but the fee remains the same. So just another great benefit to highlight there. So the Canadian US dollar exchange rate has been moving around over over the last decade or so. Chris, what insight can you provide us on this exchange rate? This is obviously the most popular foreign exchange rate that Canadians are plugged into.
Yeah, for sure. So it's kind of interesting, currencies, generally are not thought of as kind of a return generating asset. They tend to currencies, like Canadian dollar versus US dollar tends to have a long-term average. It's probably about, $1.25 Canada to the US dollar, or 80 cents. And if you're looking at it the other way, that's a long-term historical average. But certainly, as you can see here on a year-to-year basis, they can move, and they can move significantly. So obviously around 2008, we remember there's a lot of volatility there. The US dollar gained in strength in 2008 because it tends to be kind of a low risk asset. People go to US dollars, buy treasuries. But around 2008, both in 07, 09, you saw, a significant depreciation in the US dollar. So, it's just something that can show you that currency can, definitely play a significant role in returns. And, when you see some of the numbers like this, I mentioned that's why there has been some interest, historically, for Canadians to hedge, in that they can mitigate the impact of these numbers that we're seeing here. Now, that being said, there can also be advantages to having unhedged exposure as well, because one thing you notice is when, say, equities, for example, tend to go down, the US dollar goes up, and you can see that in 2008, most notably. So currencies can also give you a diversification benefit. So there's a lot to think through, but certainly having an awareness of, and I don't think we can get into all the kind of nooks and crannies and thought process around hedging, but having an understanding that currency can drive returns, I think is important for investors to think about.
So Chris, a lot of Canadians have US dollars, and it's because we travel to the US quite frequently. Many Canadians own property down there, spend a lot of time down there. Hopefully when travel reopens, that can get underway again. But what kind of tips would you suggest, or ideas perhaps, for Canadians who frequently use US dollars, or who may be holding a lot of US dollars right now? What could they be thinking about?
Well, for sure. So, I think there's always can be some concerns in the market, but generally speaking, staying invested as a number one rule tends to work out over time. Now, we know a lot of Canadians do have, decent amount of US dollar, US dollar cash or investments, on their books. Statistics are probably around maybe 10 to 20% of overall assets could be, as much as 20 could be in US dollars. So, the first bullet here, I think, is one that's really just very simple and intuitive. If you have US dollars, and you may need those US dollars in the future, but simply just avoiding foreign exchange conversions can be very beneficial. Unfortunately, those exchange conversions can cost, could cost anywhere from, maybe 25 or 30 basis points, so 0.2, 0.3%, or up to even 1.5%. And I don't remember what credit cards are. They can be even higher. So, keeping currency without doing foreign exchange transactions can be beneficial, and that's really where the .U's come in. If you have excess US dollars, you want to put them to work, you can buy these ETFs traded in Toronto and not have to do a currency conversion. So right away, that's an immediate benefit. And the rest of what we're saying there is, we find that it can often really fit certain investors who, for whatever reason, have those US dollars, or they have US expenses, perhaps a vacation property, perhaps they're paying bills in US dollars. You can buy US bearing, US dollar denominated ETFs that distribute US dollar income, and it can just be a very effective way to manage investments, to manage expenses without having to constantly flip back and forth between Canadian dollars and US dollars and incur those charges. So I think that's one really solid financial planning tip, and these US dollar ETFs can give you that ability to really put those US dollars to work.
Yeah, there's definitely a lot of benefits to using .U ETFs. So Chris, you mentioned avoiding those exchange and transaction costs. That's a big benefit. And then I'm going to highlight again the matching cash flow to expenses, because I know so many Canadians, like you mentioned, have either vacation properties down in the US, maybe their children are going to university in the US and have tuition and other expenses, or just travel down there frequently and happen to have bills to pay in US dollars. The ability to match the cash flows coming from your investments to the expenses that you have in US dollars is brilliant, I think, and it just really simplifies the entire process of managing your currencies and managing your currencies that aren't in Canadian dollars. A couple other benefits here. So there's no US estate tax exposure. So a .U ETF, even though it holds US dollars and it holds US equities or US bonds, it's actually considered a Canadian asset. So it's a domestic asset because it is trading and listed here in Canada. So that has some benefits. And then you do not have to fill out that T1135 foreign income verification form. I know at tax season, one less form to fill out. That is always very helpful. Because again, this is not a US asset. It's not trading in the US. And I was actually looking today at an investor economics report, and I noticed there's a lot of assets in US listed ETFs that are held in direct brokerage accounts, which is probably not as surprising. I know there's a lot of big providers down there, ARC and Vanguard and you know the like, Spider, but something to think about as well when you're thinking about your assets and where they're residing, whether it's domestic or non-domestic. And kind of sticking with this theme, so Chris, what I've pulled here is we have SPY, which is an S&P 500 ETF trading in the US, and then we have ZSP.U, an S&P 500 ETF trading in Canada. So essentially to the exact same ETFs. What can you tell us about the performance? I think it's pretty clear here, but you could walk us through the differences or no differences.
Yeah, for sure. So very little difference, as you can see. So both of these ETFs track the S&P 500. The BMO one is, I believe, 1 basis point cheaper. So that's nice that we have that in our favor. SPY is one of the biggest. Actually, it's the biggest ETF in the world. But you can see here the performance is almost exactly the same. Not to get too into the details, but you do see a slight, very slight, if you look at that annualized return number, about 0.25% benefit for SPY, but that's really due to withholding tax. So, you know, regardless of whether, you know, as a Canadian, if you buy a Canadian ETF with a US exposure, such as the ZSP.U, or you buy a US ETF, you'll be subject to foreign withholding tax, which happens when you collect foreign dividends. You know, in the case of SPY, US investors who buy SPY, which is what we're seeing the return here, they're not subject to that, but however, the returns are embedded into ZSP.U. So just a little small point to say that really these returns are, you know, if you adjust for withholding tax, they're actually totally identical. So, you know, like you said, for those benefits, you know, a lot of times Canadian can have benefits in terms of keeping that ETF within Canada. So even if you have US dollars, trading on the Toronto Stock Exchange can help mitigate tax issues. It can help mitigate other cross-border issues and just keep things simpler for investors, and simple is always good. So you can see you get the exact same exposure, but right here in Canada.
Simple is better. I definitely agree with that. Thanks for walking us through that Bloomberg chart. So in Canada, you know, we talked about earlier the first or one of the first .U ETFs was listed back in 2012. And now there are so many trading on the exchange that you could actually build yourself an entire portfolio, diversified portfolio, using several different .U ETFs as building blocks. So what I'm showing you here is actually, I pulled this right from our BMO ETF roadmap. You can see how easy it is to see everything. This is what BMO offers. So you can see there's an extensive suite of .U ETFs, but most of the major providers here in Canada all offer US dollar options as well. But really another added benefit, not just equity, you see there's a lot of fixed income options here. I want to just mention one thing about a .U ETF. If you're looking at a quote online and you're pulling a quote, not all quoting systems are quoting .U ETFs right now. However, this is improving, and we actually took a look at it this week, and the quotes are looking a lot better than they have in the past, but just to keep that in mind. And then secondly, if you are looking at a US provider that does list ETFs here in Canada, like an iShares or a Vanguard, they actually don't usually have .U ETFs. And the reason being is because they already have those ETFs listed in the US. So thinking about SPY, for example, wouldn't offer a .U ETF here. So just something else to keep in mind. So Chris, we put together this fabulous report to help investors kind of dive a little deeper on these options here for .U ETFs and the types of building blocks. And we put together kind of our ideas of some of the ETFs available to them. And there's kind of two different ways of looking at it. So the first way is if you're looking for more of a broad market approach to putting your US dollars to work. Can you just talk us through these two tickers here on the screen and maybe some considerations around them?
Yeah, for sure. So yeah, I think it's 18 tickers on the .U, and we highlighted 5, as you mentioned. So the 2 here are kind of more equity growth portfolios. Like you said, you can build really strong portfolios, and I think you could use either of these 2 ETFs, which have exposure to U.S. equities, to be, be a solid component of an overall portfolio. So, I think the S&P 500, Danielle, as we know, I don't think it needs an introduction. It was an 8 basis point, which is, almost minimal cost to investors. So very low cost, very cheap, great history of performance, and obviously very large and high quality companies within that S&P 500 index. And then the other one we highlighted is the USA quality, so high quality index. So this is what we would call a smart beta approach, where it has an element of market capitalization weighting, so weighted by the largest companies like the S&P. But it also takes exposure to higher quality companies within that. So it looks for high profitability companies with consistent earnings and companies with low debt. Actually, something we think could be beneficial as rates are increasing, look pretty poised to increase in 2022. Having exposure to companies that don't have very much debt exposure could really be beneficial. They won't be subject to higher funding costs, and just overall the quality factor, which we leverage from MSCI, has just good track record of success, and I think can really be additive for returns. So both ETFs, really solid ETFs for getting exposure to broad equities through US dollar listed ETFs.
And then kind of the other side of the coin here, we have, you provided us with some great ideas for that income approach. And this might resonate more with those investors who have those expenses down in the US and want to match their cash flows from these ETFs to their expenses, because a reminder, the cash flows all are paid out in US dollars. What can you say about these 3 tickers here on the screen, Chris?
Yeah, and you're right, Danielle. We've seen, within this kind of little niche of .U ETFs, we've seen a lot of interest in income-bearing ETFs. ZWH.U, that's our US high dividend covered call ETF. So on the income side, benefiting 2 ways. One, by having a dividend approach within the portfolio, and then additionally adding on that covered call overlay to increase the income. So looking at kind of a yield around 6 to 6.5% net there, and that's certainly been something that's been attractive to clients, like you said, some of which are looking to pay bills or derive an income stream from their US dollar assets. And 2 other great ones as well: premium yield, which is a little more defensive, but again a very strong yielder, about a 6% yield, and has that ability to participate in equity market growth as well. Dynamically shifting into and out of equities, but a great income-oriented solution. And last but not least, U.S. preferred shares. And I think, again, maybe something that doesn't sound as exciting, but it's one of the great things about our ETF lineup, I really believe, is having so many different tools to achieve diversified portfolios. And so that ability to get to have exposure to U.S. preferred shares, and to make it easily easily accessible to Canadian investors, I think is really beneficial. And again, it's yielding somewhere around 5%, I believe, on that one. So some great income tools that can really help round out the portfolio, generate yield, and we've always been known for, having a lot of really solid income generating solutions as well. So can either fit next to those more equity growth oriented ones, or more in an income focused portfolio. Lots of good solutions to choose from there.
Great, thanks for that, Chris. And if anyone wants to learn more about these tickers, we do have this entire report. We posted it on etfmarketinsights.com under resources. It's right down there in our education center. And if you'd like to know the yields, especially on some of the more income-oriented tickers, just click on our ETF roadmap. That's also on etfmarketinsights.com. We update that monthly, so you can get an up-to-date yield number, because of course those yields do move around as the market moves and the price of the ETF moves around as well. Now we have one question. I think everyone was really enjoying their holidays, because we had one question come in, and we really are grateful for the question. So thank you for that. Chris, I was hoping you could help us with this. So it's a question about liquidity and volume on an ETF. And the question is if an ETF doesn't trade every day, does that mean I won't be able to sell it when I want to? What can you tell us about this?
Yeah, for sure. And actually a really great question, considering what we're talking about, the .U ETFs, because they tend to be, our .U ETFs, it's all one fund, it's a series of a fund, but the .U tends to be, a little more of a niche, call it little brother or little sister of the parent ETF, and consequently you don't always see as much volume on the .Us. But to answer the question, that whether there's volume or not, even if there was no volume, doesn't mean that you can't trade an ETF. So, as always, the liquidity of an ETF, it's going to derive from that underlying liquidity. So let's say we're talking about an S&P 500 .U ETF. As long as the US market is open and there's liquidity in the market, even if that specific ETF hasn't traded, you'll still be able to find a very robust bid and ask to go in and transact on that ETF. So there's always, that's the general rule of ETFs, is look at what the ETF actually holds, and that's really your true liquidity profile. And so as long as markets are open, the underlying markets for equities or fixed income, then we construct our ETFs to be liquid and robust, and you shouldn't have any challenges. And and then if you do, feel free to get in touch with us, and we'll certainly help. But it's something investors obviously think about when you don't see volume, but there should be a very robust bid and ask as long as those underlying markets are open. Just make sure to use limit orders. I think is a good practice, and should be fine.
Thanks so much for clarifying that. I know this is one of the most popular questions we get. And maybe I'll just add, for anyone looking up the volume of ETFs and online, just keep in mind that there's actually, I think we are at like 10 or 11 different exchanges, or maybe more, here in Canada. And the Toronto Stock Exchange is obviously the most widely known, but that's not the only place where ETFs trade. But quite often, it's the only data set that's published. So when we look at volume numbers online, oftentimes it's only quoting the Toronto Stock Exchange volume, but really there's actually trading happening on, I think Toronto Stock Exchange is only about 25 to 30% of all ETF trading, and there's several other exchanges also with volume numbers as well. So just something to keep in mind when you're looking up these volume numbers online. Well, that's it. It was so great to be back with you all. Thanks so much for joining us. If you'd like to watch any of our past shows, they're all on YouTube, or just go to etfmarketinsights.com to watch a replay of any of our shows. And we hope to see you next week. Our friends from Investor Line will be joining us, and we will be talking about the future of online investing. You don't want to miss that. We'll see you next Friday.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.